Uh, Good afternoon, or night, or morning, depending on when you hear this. We're gonna be talking about taxes. Taxes today. I like going on rants about taxes, as do many people. But I feel as if nobody really understands them. So this video is gonna be, hey, well, what are taxes? We're going to talk about the different types of taxes and where your taxes are going. So let's get started. First, let's ask ourselves the question: what are taxes? Well, taxes are involuntary fees levied on individuals or corporations and enforced by a government entity, whether local, regional, or national, in order to finance government activities. In economics, taxes fall on whomever pays the burden of the tax, whether this is the entity being taxed, such as a business, or the end consumers of the business's goods. Now, what does that mean? It means that they're just taking money from you, quite simply. No, that's it. The government is taking money from you. Let's continue. Let's understand taxes. Let's try to do that. To help fund public works and services, and to build and maintain the infrastructures used in a country, the government usually taxes its individuals and corporate residents. The tax collected is used for the betterment of the economy, and I use that lightly, and all living in it. In the United States and many other countries, taxes are applied to some form of money received by the taxpayer. The money could be income earned from a salary, capital gains from investment appreciation, dividends received as additional income, payments made from goods and services, or as such. A percent of the taxpayer's earnings or money is taken and remitted to the government. Payment of taxes at rates levied by the state is compulsory. And tax evasion, that's the deliberate failure to pay one's full tax liabilities. That's punishable by law. So tax evasion is not good. Most governments use an agency or department to collect taxes. In the United States, this function is performed by the IRS, or the Internal Revenue Service. There are several very common types of taxes, all of which we'll go into detail about. We'll go ahead and list them all for you and give a brief description about them, and then we'll go more in depth. Income tax. This is a percentage of the individual's earnings filed to the federal government. There's corporate tax, a percentage of corporate profits taken as tax by the government to fund federal programs. Sales tax. Taxes levied on certain goods and services. Property tax, based on the value of land and property assets. There are tariffs. These are taxes on imported goods imposed in the aim of strengthening internal businesses. And estate tax, rate applied to the fair market value of property in a person's estate at the time of death. Let's go ahead and start off with income taxes. How do income tax work? Most countries employ a progressive income tax system in which the higher income earners pay a higher tax rate compared to their lower income counterparts. The United States imposed the nation's first income tax in 1862 to help finance the Civil War. Fun fact. After the war, the tax was repealed. It was reinstated during the early 20th century. In the United States, the Internal Revenue Service, or the IRS, collects taxes and enforces tax law. The IRS employs a complex set of rules and regulations regarding reportable and taxable income deductions, credit, and the such. The agency collects taxes on all forms of income, such as wages, salaries, commissions, investments, and business earnings. The personal income tax the government collects can help fund the government programs and services such as Social Security, national security, schools, and roads. We'll go more into where your taxes go in a bit. I'll talk about some of the types of income tax. We have individual income tax. Individual income tax, also referred to as personal income tax. This type of income tax is levied on individuals' wages, salaries, and other types of income. This tax is usually a tax, the state imposes. Because of the exemptions, deductions, and credits, most individuals do not pay taxes on all of their income. The IRS offers a series of income tax deductions and tax credits that the taxpayers can make use of to reduce the taxable income. While a deduction can lower your taxable income and tax rate, that is used to calculate your tax, a tax credit reduces your income tax by giving you a larger refund of your withholding. The IRS offers tax deductions for healthcare expenses, investments, and certain education expenses. For example, if a taxpayer earns $100,000 in income and qualifies for $20,000 in deductions, the taxable income reduces to $80,000 because, 100,000 minus 20,000 equals 80,000. Tax credits exist to help reduce the taxpayer's tax obligation or amount owed. They were created primarily for those in middle income and low-income households. To illustrate, if an individual owes $20,000 in taxes but qualifies for $4,500 in credits, their tax obligation reduces to $15,500 because, $20,000 minus $4,500 is equal to $15,500. Now, business income taxes. Businesses also pay income taxes on their earnings. The IRS taxes income from corporations, partnerships, self-employed contractors, and small businesses. Depending on the business structure, either the corporation, its owners, or the shareholders report their business's income and then deduct their operating capital expenses. Generally, the difference between their business income and their operating and capital expenses is considered their taxable business income. State and local income tax. Most U.S. states also levy personal income taxes. As of 2020, there are 7 states with no income tax. These states are Alaska, Florida, Nevada, South Dakota, Texas, go Texans, Washington, and Wyoming. In addition, 2 other states, New Hampshire and Tennessee, do not tax earned income. However, they do tax dividends and interest. However, Tennessee is set to eliminate those taxes on dividends, and interest, in an effort to repeal the tax in New Hampshire failed in 2018. And it is projected that the number of states in the U.S. with no income tax will reach 8 in 2021. That's great. For taxpayers, it might not be cheaper to live in a state that does not levy income tax. This is because states often make up their lost revenue with other taxes or reduced services. In addition, there are other factors that determine the affordability of living in a state, including health care, cost of living, and job opportunities. Okay? Next, let's talk about corporate tax. Excuse me. A corporate tax is a levy placed on a firm's profit by the government. The money collected from corporate taxes is used as a nation's source of income. A firm's operating earnings are calculated by the deducting expenses, including the cost of goods sold, or the COGS, COGS, and depreciation from revenues. Next, tax rates are applied to generate a legal obligation that the business owes the government. Rules surrounding corporate taxation vary greatly worldwide, but they must be voted upon and approved by a country's government to be enacted. Some areas, such as Jersey, are considered tax havens, and such are heavily prized by corporations. Here are some key takeaways. Corporate taxes are collected by the government as a source of income. Taxes are based on operating earnings after expenses have been deducted. The corporate tax rate in the United States is currently at a flat rate of 21%. Before the Trump tax reforms of 2017, the corporate tax rate was 35%. A company can register as an S corporation to avoid double taxation. An S corporation does not pay corporate taxes as the income passes through the business owners who are taxed. Through their individual tax returns. Let's try to understand corporate tax. The federal corporate tax rate in the United States is currently a flat 21%, thanks to the Tax Cuts and Jobs Act, the TCJA, which President Donald Trump signed into law in 2017, and which went into effect in 2018. Previously, the maximum U.S. corporate income tax rate was 35%. U.S. corporate tax returns are typically due March 15th. Corporate may send a request for a 6-month extension to file their corporate tax returns in September. Installment payment due dates for estimated tax returns occur in the middle of April, June, December, and December. Corporate taxes are reported on Form 1120 or 1120 for U.S. corporations. If a corporation has more than $10 million in assets, it must file online. Because of the coronavirus pandemic, the IRS extended the April 15, 2020 tax filing deadline for individuals and businesses to July 15th of 2020. Businesses that need an extension to file they must fill out Form 7004 or 7004. An extension to file is not an extension to pay taxes owed. Most states also extended their 2020 tax filing deadlines for individuals and businesses. But check your state's deadline. Idaho, for instance, setting a filing date of June 15th. The deadline was estimated federal tax payments normally due by June 15th, 2020, was also extended without penalty to July 15th, 2020. Let's talk about corporate tax deductions. Corporations are permitted to reduce taxable income by certain necessary and ordinary business expenditure. I'm sorry, I've never seen this word before. Let's look it up. Oh, business expenses. I'm sorry. It was worded weird. Let's continue. Corporations are permitted to reduce taxable income by certain necessary and ordinary business expenses. All current expenses required for operation of the businesses are fully tax deductible. Investments in real estate purchased for the intent of generating income for businesses are also deductible. A corporation can deduct employee salaries, health benefits, tuition reimbursement, and bonuses. In addition, a corporation can reduce its taxable income by deducting insurance premiums, travel expenses, bad debt, interest payments, sales tax, fuel taxes, and excise taxes. Tax preparation fees, legal services, bookkeeping, and advertising can also be used to reduce business income. Let's talk about special considerations. A central issue relating to the corporate taxation is the concept of double taxation. Certain corporations are taxed on taxable income of the company. If this net income is distributed to shareholders, these individuals are forced to pay individual income taxes on the dividends received. Instead, a business may register as a S corporation and have all income pass through the business owners. An S corporation does not pay corporate taxes, as all taxes are paid through individual tax returns. Let's talk about the advantages of corporate taxation. Paying corporate taxes can be more beneficial for business owners than paying additional individual income tax. Corporate tax returns deduct medical insurance for families as well as fringe benefits, including retirement plans and tax-deferred trust. It is easier for a corporation to deduct losses. A corporation may deduct the entire amount of losses, while a sole proprietor must provide evidence regarding the intent to earn a profit before the losses can be deducted. Finally, profit earned by a corporation may be left within the corporation, allowing for tax planning and potential future tax advantages. We're going to move on to sales tax. What is a sales tax? A sales tax is a consumption tax imposed by the government on the sale of goods and services. A conventional sales tax is levied at the point of sale, collected by the retailer, and passed on to the government. A business is liable for sales taxes in a given jurisdiction if it has a nexus there, which can be a brick and mortar location, an employee, an affiliate, or some other presence, depending on the laws in that jurisdiction. Let's try to understand sales tax. Conventional or retail sales taxes are only charged on the end user of a good or service. Because the majority of goods in modern economies pass through a number of stages of manufacturing, often handled by different entities, a significant amount of documentation is necessary to prove who is ultimately liable for sales tax. For example, let's say a sheep farmer helps sell wool to a company that manufactures yarn. To avoid paying sales tax, the yarn maker must obtain a resale certificate from the government saying that it is not the end user. The yarn maker then sells its product to a garment maker, which must also obtain a resale certificate. Finally, the garment maker sells fuzzy socks to a retail store, which will charge the customer sales tax along with the price of said socks. Different jurisdictions change different sales taxes, which often overlap, as when counties, and let's retry that one. Different jurisdictions change different sales taxes, which often overlap, as when states or counties each levy their own sales tax. Sales taxes are closely related to use taxes, which applies to residents who have purchased items from outside their jurisdiction. These are generally set at the same rate as sales taxes, but are difficult to enforce, meaning they are in practice only applied to a large purchase of tangible goods. An example would be a Georgia resident who purchases a car in Florida. She would be required to pay the local sales tax as though she had bought it at home. It's kind of interesting, isn't it? Let's talk about nexus. Whether a business owes sales taxes to a particular government depends on the way the government defines nexus. A nexus is generally defined as a physical presence, but this, in quotes, presence, is not limited to having an office or a warehouse. Having an employee in a state can constitute a nexus, as can having an affiliate, such as a partner website that directs traffic to your business's page in exchange for share of profits. This scenario is an example of the tension between e-commerce and sales tax. For example, New York has passed Amazon laws requiring internet retailers such as Amazon.com Incorporated to pay sales tax taxes despite their lack of physical presence in the state. We're going to move on to property tax. What is property tax? Property tax is a tax paid on property owned in an individual other than legal entity, such as a corporation. Most commonly, property tax is a real estate. It's calculated by a local government where the property is located and paid by the owner of the property. The tax is usually based on the value of the owned property, including land. However, many jurisdictions also tax tangible personal property, such as cars and boats. Gotta hate it when they tax your boats. The local governing body will use the assessed taxes to fund water and sewer improvements and provide law enforcement, fire protection, education, road and highway construction, libraries, and other services that benefit the community. Deeds of reconvenience do not interact with property taxes. Let's talk about some key giveaways and some takeaways. Property owners pay property tax calculated by the local government where property is located. Property tax is based on the value of their property, which can be real estate or, in many jurisdictions, also tangible personal property. Improvements in water and sewer use, the assessed taxes. It's kind of interesting, if I do say so myself. Let's try to understand property tax. Property tax rates and types of property taxes. Property tax rates and the types of property taxed vary by jurisdiction. When purchasing a property, it is essential to scrutinize the applicable tax laws. In most organization for economic cooperation and development, wow, that's a long one, or OECD countries, immovable property taxes represent a low proportion of federal revenue when compared to income taxes and value-added taxes. However, the rate in the United States is substantially higher than in many European countries. How does property tax work? The amount owners owe in property tax is determined by multiplying the property tax rate by the current market value of the lands in question. Most taxing authorities will recalculate the tax rate annually. Almost all property taxes are levied on real property, which is legally defined and classified by the state apparatus. Real property includes the land, structures, or other fixed buildings. Ultimately, property owners are subject to the rates determined by the municipal government. A municipality will hire a tax assessor who assesses a local property. In some areas, the tax assessor may be an elected official. The assessor will assign property taxes to owners based on current fair market values. This value becomes the assessed value for the home. The payment schedule of property taxes varies on locality. In almost all local property tax codes, there are mechanisms by which the owner can discuss their tax rate with the assessor or formally contest the rate. When property taxes are left unpaid, the taxing authority may assign a lien against the property. Buyers should always complete a full interview or a full review of outstanding liens before purchasing any property. You're probably asking yourself, what's the difference between property tax and real estate tax? People often use the terms property tax and real estate tax interchangeably, and it's partially true. Real estate is a property tax. However, that's not true the other way around. Not all property taxes are real estate taxes. Like how all rectangles are squares, but not all squares are rectangles. As noted above, in addition to real estate, many jurisdictions also levy property taxes against tangible personal property. According to a 2019 report by the Tax Foundation, 43 states tax tangible personal property. Both types of property are tax deductible if you file Schedule A with your income taxes. However, since the Tax Cuts and Jobs Act, the amount of state and local taxes or SALT taxpayers could deduct on their federal income taxes fall from no limit to $10,000 per year for either married couples or single taxpayers. Those in the married filing separately category have a $5,000 cap. So, here's the difference. Real estate taxes are taxes on real property only. Property taxes can include both real property and tangible personal property. Let's move on to tariffs. What is a tariff? A tariff is a tax imposed by one country on the goods and services imported from another country. How does a tariff work? Tariffs are used to restrict imports by increasing the price of goods and services purchased from another country, making them less attractive to domestic consumers. There are two types of tariffs. A specific tariff is levied as a fixed fee based on the type of item, such as a $1,000 tariff on a car. An ad valorem tariff is levied because of the item's value, such as 10% of the value of the vehicle. Interesting. Here are some key takeaways. Governments impose tariffs to raise revenue, protect domestic industries, or exert political leverage over another country. Tariffs often result in unwanted side effects, such as higher consumer prices. And tariffs have a long and contentious history, and the debate over whether they represent good or bad policy rages on to this day. Let's move on to estate taxes. What is an estate tax? An estate tax is a levy on estates whose value exceeds an exclusion limit set by law. Only the amount that exceeds the minimum threshold is subject to tax, assessed by the federal government and about a dozen state governments. These levies are calculated based on the state's fair market value rather than what the deceased originally paid for its assets. The tax is levied by the state in which the deceased person was living at the time of their death. Under what is known as the unlimited Marshall deduction, the estate tax does not apply to its assets that will be transferred to a surviving spouse. Excuse me. However, when the surviving spouse who inherited an estate dies, the beneficiaries may owe the estate taxes if the estate exceeds the exclusion limit. How do federal estate taxes work? Well, as of 2019, the Internal Revenue Service, or the IRS, requires estates with combined gross assets and prior taxable gifts exceeding $11.4 million to file a federal estate tax return and pay estate tax as required. For the 2 years prior, 2017 and 2018, the return and taxes were owed if the estate exceeded $5.49 million and $11.18 million, respectively. In many instances, the effective U.S. estate tax rate is substantially lower than the top federal statutory rate of 40%. This happens in part because the tax being assessed only on the portion of an estate that exceeds an exclusion limit. To illustrate the impact of the exclusions, consider an estate that's worth $13 million. With the 2019 exclusion limit of 11.4 million, federal estate taxes would be owed on less than 2 million of the estate, or less than 1/4 of its total assets. In addition, estate holders and beneficiaries, or their attorneys, continually find new and creative ways to protect significant chunks of an estate's remaining value from taxes by taking advantage of discounts, deductions, and loopholes that have been enacted by policymakers over the years. An estate that escapes federal taxes may still be subject to taxation by the state in which the deceased person was living at the time of their death. That's because the exemptions for state and district estate taxes are all less than half of those of the federal exclusion. That said, estates valued at less than 1 million are not taxed in any jurisdictions with estate tax. Here are the jurisdictions that have estate taxes with threshold minimums at which they apply and shown parentheses. Shall we? Connecticut, 3,600,000. Washington, D.C., or the District of Columbia, 5,600,000. Hawaii, 5,500,000. Illinois, 4 million. Maine, 5,600,000. Massachusetts, 1 million. Maryland, 5 million. New York, 5 million. Oregon, 1 million. Minnesota, 2,700,000. Rhode Island, 1,561,719. Vermont, 2,750,000. Washington State, 2,193,000. Above those thresholds, the tax is usually assessed on a sliding basis, much like the brackets of income. In 2019, the tax rate is typically 10% or so for amounts just over the threshold, and rises in steps, usually to 16%. The tax is lowest in Connecticut, where it begins at 7.8%. It raises to 12%, and highest in Washington State, where it tops out at 19%. There we go. Here's some key takeaways. The estate tax is a financial levy on a state based on current value of its assets. Federal estate taxes are levied on assets in excess of 11.4 million as of 2019. But about 1 in 4 states have their own estate taxes with lower limits. Assets transferred to spouses are exempt from estate tax. Recipients of an estate's assets may be subject to inheritance tax, again above certain limits. Now that we've talked about the different types of taxes, I'll talk about where your taxes go. Where do our federal tax dollars go? In 2019, the federal government spent $4.4 trillion, amounting to 21% of the nation's gross domestic product, or GDP. Of that $4.4 trillion, over $3.5 trillion was financed by federal revenues. The remaining amount, $984 billion, was financed by borrowing. As the chart below shows, 3 major areas of spending make up the majority of the budget. There's no chart for you guys, obviously, but I'm going to read it. Social Security. In 2019, 23% of the budget, or $1 trillion, paid for Social Security, which provided monthly retirement benefits averaging to 1,503 to 45 million retired workers in December of 2019. Social Security also provided benefits to 3 million spouses and children of retired workers. 6 million surviving children and spouses of deceased workers and 10 million disabled workers and their eligible dependents in December of 2019. Medicare, Medicaid, CHIP, and marketplace subsides. 4 health insurance programs: Medicare, Medicaid, the Children's Health Insurance Program, or CHIP, and Affordable Care Act, ACA, marketplace subsides, together accounted for 25% of the budget in 2019, or $1.1 trillion. Nearly 3/5 of this amount, or $651 billion, went to Medicare, which provided health coverage to around 61 million people who are over age 65 or have disabilities. The rest of this category funds Medicaid, CHIP, and ACA, subsidly, and marketplace costs. In a typical month, Medicaid and CHIP provide health care or long-term care to about 82 million low-income children, parents, elderly people, and people with disabilities. In 2019, 9.6 million of the 11.4 million people enrolled in health insurance through the ACA marketplace received subsides that lower premiums and out-of-pocket costs at an estimated cost of about $56 billion. Defense and international security assistance. Another 16% of the budget, or 693 or 97 billion, paid for defense and security-related international activities. The bulk of the spending in this category reflects the underlying cost of the Defense Department. The total also includes the cost of supporting operations in Afghanistan and other related activities described as overseas contingency operations in the budget, funding for which totals $77 billion in 2019. Here are 2 other categories together that account for less than 1/5 of spending. Safety net programs. About 8% of the federal budget in 2019, or $361 billion, supported programs that provide aid to individuals and families facing hardship. Safety net programs include the refundable portions of Earned Income Tax Credit and Child Tax Credit, which assist low and moderate income working families. Programs that provide cash payments to eligible individuals or households, including supplemental security income for the elderly or disabled poor, and unemployment insurance. Various forms of in-kind assistance for the low-income people, including SNAP, food stamps, school meals, low-income housing assistance, child care assistance, and help meeting home energy bills, and various other programs such as those aid abused or neglected children. Interest on debt. The federal government must make regular interest payments on the money it borrowed to finance past deficits. That is, on the federal debt held by the public, which reached $16.8 trillion by the end of the fiscal year 2019. In 2019, these interest payments claimed $375 billion, or about 8% of the budget. That's going to be about all for today. I'm sorry that I stumbled a few parts, and I have a bit of a speech impediment, but I hope you still enjoyed. I hope you learned a lot about taxes. Next time we'll be talking about the International Revenue Service, or Internal Revenue Service, as it's actually called, the IRS. Thank you, and I'll see you later.